About time you met my partner, my financial side.
All successful people and companies have a financial side.
Let's go, partner.
But to really be a winning team, you might need some help.
We need some help.
You need Payne Weber behind you for financial expertise, sound advice. We believe the quality of life just might depend on the quality of your financial services.
Thank you, Payne Weber. You're awfully stiff. You've got to loosen up a little bit.
And then you wonder why Payne Weber is no longer a brokerage firm.
You do wonder that. And that because they hired Jimmy Connors to be their lead advisor. Huh?
Well, Jimmy, I love Jimmy Connors.
I do too.
But the commercial, right? All of a sudden he's playing tennis, and then it's a carpet. The commercials that they had back in the 80s when it was coming into the financial services is something else.
True.
Do not get your, I mean, does that encourage you to invest with Payne Weber? I don't know. I hope not. Let's go to the true-false question.
When creating a retirement income stream, I should always liquidate my safe assets first and my more aggressive assets second.
So this is a really good question because it could be true or false. It really depends, right? So here's the problem is that most people say, all right, well, here, just deplete the cash and then the bonds first and then go after the stocks. But if stocks are on a nice tear out, well, then you still have to rebalance the portfolio. So now it's going to be a little bit more challenging of, all right, you have to look at the portfolio itself to determine what asset class that you want to sell to create that income. Because if I keep my stocks growing, then I'm going to take on more risk than the overall portfolio probably needs to be. And so you might want to sell stocks in some instances to create that income. In times where the markets are volatile, then of course you want to grab your safer investments and not sell stocks when they're down.
Yeah, I think that's well said. And I think really when you think about it, probably more often than not, you will pull from your safe assets because they're not so volatile. You don't necessarily want to be selling stocks when they're shooting up or shooting down. But you do need to look at your portfolio, and there are times when stocks go up and you need to rebalance, or there's times when stocks go down, you need to rebalance. And so that should affect where you're pulling your assets from. So the answer is in this case false, because you don't always pull from your safe assets, although that's common.
Always. So that was kind of one of those.
That was the trick. You remember the SAT test?
It's
when it's always, it's false?
Always. There you go, always. So just remember that.
Right.
You know, and here's the problem. When you look at, we're talking about a retirement income strategy and how to create the retirement income that you need, but here's the real true problem when it comes to retirement is that a lot of people are not necessarily prepared. It's not only here in San Diego, Minneapolis, Philadelphia, it's across the United States that there's a real epidemic when it comes to people's, are they truly prepared for retirement? We got a clip here that I want you to take a look at.
They've worked hard all of their lives. Now Linda and Bob look forward to retiring. But like many baby boomers, they have real concerns.
Having enough money for retirement to live in the lifestyle that we would like to live.
Linda and Bob's concerns are real. Seniors in almost every state in the country don't have the income to retire comfortably.
I have a pension with my job, so I'm really fortunate. And we have some investments.
According to the 2013 Census Bureau data, households 65 and older are living on just over $37,000 a year in 49 states. That's well short of the $45,000 per year that is recommended for retirees. Nevada and Washington, D.C. are the only districts where seniors have incomes above the $45,000 benchmark.
I don't have a definite number, I'm not sure.
Got that far yet.
Linda and Bob are taking action while they still have some time, taking classes to learn about their options for retirement planning.
We could use some fine-tuning on our plan. We have a loose plan, but we need something more definite.
Analysts say retirement savings should allow a senior to live on 70% of the average income of working adults aged 45 to 65.
We're running out of time. We won't be able to wait 20 years for it to recover.
If that doesn't tell you to get prepared, I don't know what does, Al.
Well, that's exactly right. And really, a lot of people have no idea what they should be saving and how to develop a cash flow plan. That's why we're talking about it today.
So here's another issue when it comes to retirement income planning is that depending on where the market's at. So when the markets are volatile, and if you're saving money into, let's say, your 401k plan, that actually helps you. Because when the markets are down and you're saving money, you're buying more shares of that particular stock or mutual fund. But now if you're pulling money out of the account in down markets, this is what can really blow up a retirement. Let me show you a quick example here. So let's look at this. We have $1 million, okay? So there's $1 million in this couple's portfolio, and they want to generate $50,000 a year from the portfolio, okay? And we're going to assume a 3% inflation rate throughout. Now, if I look here, we got one portfolio and another portfolio. So in the first year, the market's down 10% as they're pulling out the $50,000. The next year, it's down 5%, and then it has a 0% for year 3. And then year 4 through 27, it has a 7.5% rate of return, okay? There throughout. So that's portfolio A, let's call it. Now we have portfolio B, and we just reverse it. So the first couple of years in their overall retirement, as they're taking distributions, they have positive returns. 7.5 the first year, 7.5 the second year, and so on. And then in later years, that's where they have a negative impact. And these numbers don't, I mean, it's a negative 10%, negative 5%. It's not negative 30 or 40. But let's look at the impact here. This is a down market right away. So here's your money. You start at $1 million, and then it free falls, and you run out in about 20 years. You had $1 million. You're pulling $50,000 out per year with a 3% inflation hedge on there. But you had negative returns in the market when you first started pulling money out. You flip that over. You have positive returns. Look at this. You start with that $1 million, and it keeps growing. It doesn't, and then it tails off a little bit, and at the end, you still have close to $1 million left. This is the problem when it comes to retirement income planning. When you're saving for retirement, volatile markets help you. When you are taking money out, volatile markets will kill your retirement. You will run out of money unless you have a strategy to take out the money efficiently when it comes to what assets that you pull, and then more importantly, how much tax that you're taking on the distribution. I mean, Al, we see this quite a bit. We've been lucky for the last couple of years that we've had a really good market, but now volatile markets are back. And I mean, we're always going to see volatile markets.
Well, that is true. And so you bring up a really good point, which is when markets are volatile, as they are right now, so what do? And people get concerned, and they sell out of the stock market, and then, of course, they never recover. But here's what happens to a lot of people is they have so much invested in the stock market goes down, they pull money out of the stock market because they need expenses to live off of, and then you get to a point where I still need money to live off of, but my account's down. You're going to never recover. So let's really, Joe, let's go to a more appropriate way to figure out the right distribution plan. And I think it's got to start with your goals and what your spending is, but you got to take a look at your income sources, and let's maybe go over an example of how to create an income distribution plan.
Yeah, right, because this gets a little bit more complex, and I want to run through this example fairly quickly. But here's the problem that we see is that most individuals really don't look at their tax return when they're taking distributions. But think of it this way. If you can save money in taxes while you're taking income from your overall portfolio, guess what? You're taking less money from the portfolio, hence your money's going to last that much longer. So we have a couple of case study here. This individual needs $130,000 a year of income from the overall portfolio. Now, a lot of times when people hit that retirement age, let's call it age 65, they'll take Social Security right away, and then they'll start drawing money from, let's say, non-retirement accounts, and then they'll let their retirements continue to defer. And then when they're non-qualified or their cash accounts or anything outside of the retirement accounts are depleted, then they go to the retirement accounts. What we see there is that their income tax spikes. So you want to level out your overall income burden throughout your retirement. And here's a quick example. So at age 65, let's just assume John and Sue, they want $130,000. We're going to tell them, you know what, don't take Social Security. Let that continue to grow till age 70 because you get an 8% increase each and every year. Let's not pull any money from your retirement accounts. Let's continue to let those defer, but there's another strategy that I want to look at. Now, because they don't have any income from retirement accounts or Social Security, they have negative taxable income. So that would be line 43 on your tax return. Because of that, look at this line here. We can do a Roth IRA conversion. That's taking money from their retirement accounts, now putting it into a tax-free component. And we would do this over the next, let's say, 5 years until they turn age 70. Now, they will take all of their income over the next couple of years from their cash accounts, their non-qualified accounts. That's good if you only do other tax planning strategies. Okay? So we're doing Roth IRA conversions throughout that time period until they turn age 70. Now they turn 70, they have Social Security of $50,000. Now we'll take a little bit from their retirement accounts, okay? But now look at here. Now we can pull from different avenues, such as the Roth IRA, and then we'll take a little bit more from cash. So we can still get this $130,000 of income, but look at their taxable income. 60 grand, they're still in the 15% tax bracket. They're living in a 25% tax world, but only paying 15%. And if we look, we kept them in that 15% tax bracket starting at age 65 through age 70, and then from age 70 through life, they'll always be in this low tax bracket, spending $130,000 a year. That's true planning. If you want some help, call our number right now, 888-994-6257. We're giving away a retirement assessment. Let's take a look at how are you creating the retirement income that's going to last you the rest of your life. Got to take a break. Don't go anywhere. Show's called Your Money, and it's your wealth.
Hi, I'm Robert McCulloch, Certified Financial Planner with Peer Financial Advisors. Did you know that 36% of Americans think that they can retire by 65, but only about 11% really can?